Look, I think to understand the context in which all of this is happening, the economy is coming out of a once-in-a-100-year pandemic, and over the past year, we've had to shut down large sectors, as we've tried to manage health risk. And one shouldn't expect the reopening of the economy to be smooth. This is not something that you can just close down and reopen without bumps in the way. We have been expecting for a long time that as the economy reopens, there'd be a burst of demand. Households have accumulated a lot of involuntary savings. We've all been locked up in our houses for large parts of the year. And of course, there are constraints on the supply side, both for goods and services and in the labour market. So the key questions about today's inflation print, and as you say, further inflation prints going forward, is we're seeing a surge in demand. We're seeing some constrictions in supply that's driving inflation. How persistent is that? Clear question. Are these effects that the economy will then adjust, supply will recover and adjust, and demand after the initial burst will cool off? Or is there something more persistent that will become embedded in the chain in people's expectations? And I think we would expect some of these pressures, and we would expect transitory pressures at this stage. We've got a forecast coming now for August. We'll process all of this information. We'll try and get a better read of where supply and demand are going as the economy comes back to normal. But I think you have to see today's print in the context of what's happening in the UK, and similar things are happening in other parts of the world.
You said a word that's quite popular these days with policymakers, and that is the word transitory. And it seems to be the word that many central bankers are using to describe these series of inflation prints. My question to you as a central banker is, how long is transitory? For how long do we need to see inflation prints of above 2 percentage points before you start to deem this no longer transitory?
So I think it's, first thing I'd say is monetary policy is a question of making judgments. So I can't give you a number of months. There's no algorithm. Otherwise, you wouldn't need central bankers. You could turn it over to algorithms. So there are judgments to be made. But it's not just judgments about where inflation is today. It's judgments about what inflation is going to be in the future. Remember, it's forward-looking inflation targeting, and we have to think about monetary policy action. There's a lag before it takes effect. And for that, you really have to think about the underlying question. What's happening to demand? So will this burst of demand carry on, and how long will it carry on for? And you also have to think on the supply side. We may get, commodity prices have gone up. That will lead to a one-off increase in prices. But does it lead to a more persistent change in the rate of growth of prices, which is inflation? So that's what the forecast process is about. Understand the fundamentals that are driving this. And to be blunt, it's more difficult to do that in a situation like this, for which we have no precedent. And some of this is about risk management. When you're close to the effective lower bound, clearly you have less room to operate to stimulate the economy on that side. So you need to think also about how you weight the risks and how you manage them. But these are things we'll put together in our August forecast. And we'll reach a judgment forward-looking on whether these pressures are likely to subside as the economy comes back to normal, as people come back into the labour force, as supply adjusts, and as demand comes back to normal, or whether actually there's something more persistent here, which we would need to act against.